been an interesting time specifically to direct lending in general, specifically to the lower middle market. What you've seen in a period of higher interest rates and inflation, you've seen additional stress get brought to these companies. There's this perception, and by the way, this is a fair one, that certain market forces, economic contraction, or instability in the broader global economic environment is going to have a bigger impact on a lower middle market company than an upper middle market company. That's a fair assumption. And so the ultimate result of that is when I think about broader economic impacts into a highly underwritten, highly managed basket of lower middle market companies, you pick companies that have the cash flow dynamic of the very best large company. You put less debt on those companies and you have better lender protections such that you have the ability to take actions when there is a broader economic contraction or a pandemic or other unforeseen events that allow us to take the type of actions with and in concert with our private equity owners that allow these small companies to pivot and make sure they can continue to grow. We understand that there is a value proposition in this lower middle market. It's going to take more work because we have to look at more small companies to find those really attractive cash flow producing companies. But if we can do that, we can have an experience much different than what you see in other parts of the lending universe. We're sitting in this position of strength, meaning direct lending is producing returns. And by returns, I'm talking about first lien, senior secured, low levered companies that have a long-term performance history. So you're seeing increasing allocations into the world of direct lending because there's always that, again, that story about relative value. The average investor who's going to look at the lower middle market is going to want to understand, I see the premium, but am I taking more risk for that premium? And then I think it also helps when people look specifically to the lower middle market. For 23 years, we've targeted this part of the marketplace. 10 plus years ago, the institutional investor was really the first mover into this asset class. Retail had, a smaller piece, insurance a smaller piece, but the institutional investors really dominated this sector. What's taken place is, as direct lenders like TPG Brook and others have scaled, we've come to this recognition that it wasn't an asset problem. It wasn't that we couldn't attract those type of investors. It was a structuring problem. So in the case of retail, the advent and growth of the BDC, that structure, you've seen those really come to the forefront. Then you look at the insurance investors. This all comes down to what are the capital charges an insurance company gets in different parts of the investor universe. For direct lending, this whole advent of something like structured notes, which is again the same pool of assets, but structured in a way that the insurance companies got better capital treatment. So their interest in expanding their exposure to direct lending went up. While inflation and interest rates aren't going to magically turn on their head this next year, we do look and sit back and feel like the market's modulating from the perspective of where interest rates are going to go, and inflation seems to be more under control. What that'll lead to is more transaction volume, which means more lending opportunities. Then you add the fact today that with roughly $20 billion of assets under management and over 260 borrowers, that existing base of our business continues to grow through add-on acquisitions and other activities. Our existing portfolio continues to grow. We're very excited to be able to deploy capital, and we feel very good that we have the backing of this world-class company behind us to allow us to do that.